I was 25 years old. My company, iContact, was doing $40 million in annual recurring revenue. And I made a decision that year to take $3 million off the table and sell some of my own shares and turn them into cash. But unlike what most people think, I was able to do this without selling the majority of the company. Fast forward to 2 years later, and we sold the whole company for $169 million for an even bigger liquidity event and second bite of the apple. Well, today I'm going to show you exactly how we did this secondary share minority recap transaction and explain the structure of how we sold a small part of our SaaS business for cold, hard cash. The founder's dilemma. If you're a successful company founder, 90% or more of your net worth is likely tied up in a single asset, your company's stock. On paper, you're wealthy and things are looking pretty good. But in reality, your bank account probably doesn't reflect that. Odds are you might have a mortgage to pay or a family to support. And the problem is all your wealth is concentrated in one place, which is inherently risky. Traditionally, you'd have two options. You'd either bootstrap forever, reinvesting every single incremental dollar back into the business, or you'd work toward a full M&A exit or raise capital through an IPO, creating eventual liquidity. But there is a third option, a path that lets you secure your family's financial future today. It allows you to take some chips off the table, and it lets you do this while still holding on to the majority of your shares and the majority of your control for a much bigger outcome down the road. It's called selling secondary shares. Here's my story of taking $15 million off the table at iContact before we sold the company. It's 2010. My SaaS company, iContact, is at 40 million in ARR. We're growing fast, about 80% year over year. We'd actually just gone through a process to sell the company to Salesforce for $100 million. But the deal fell apart at the last minute. Mark Benioff ended up buying one of our competitors, ExactTarget, instead. And that experience was a huge wake-up call. We realized we didn't want to have all our eggs in the same basket in one single eventual exit event that may or may not happen. So we decided to pursue a different path. We hired a top-tier investment bank, Allen & Company, out of New York City, one of the leaders in media and internet banking. And they helped us go out to market and raise a second round of capital, our Series B. But this wasn't just a primary round to fund the business. It was a $40 million round that we raised through a growth equity firm called JMI Equity. $25 million of that went into the company's bank account to fuel more growth and more investment in scalable ads and R&D, and the other $15 million was used to buy back shares from myself, my co-founder, and other early team members to provide liquidity. This is called a secondary sale. I personally sold about 15% of the shares I had, and I got about $3 million in cash. At 25 years old, that was life-changing money for me, especially in North Carolina, where I lived at the time. It gave me true financial peace of mind. It paid off my parents' mortgage, and I knew that no matter what happened with the company from that point on, my family would be secure. That peace of mind allowed me to take even bigger swings with the business and end up selling for a much larger valuation just about 18 months later. And the good part, I still own the majority of my equity. Now, less than 2 years later, we ended up getting acquired by a public company called Vocus, now owned by Cision, for $169 million. So what is a minority recap? A minority recap, it's a transaction where you sell less than 50% to an outside investor. This investor is often a growth equity or private equity firm. The key is that you as the founder retain majority control of the company, or the founding team will, in most cases, retain majority control of the company. You're still the one driving the ship, and if you want to stay CEO, you can. That's what's unique about these deals. They often have two parts to them. Primary capital, this is new money that goes directly into the company's balance sheet and bank account to be used for growth, acquisitions, or other strategic initiatives. And secondary capital, this is the money used to buy existing shares from founders, early employees, and early investors. This is the founder liquidity part and the exciting part. So sometimes if your company is already profitable and doesn't need growth capital, the deal can even be 100% secondary. Now, if you're still losing money, but you have an ARR above 10 million, you can do a part of the deal as secondary, maybe 10 to 20% of the round. You get a significant cash payout now, and you still have your remaining equity for a bigger win later when you fully exit. By the way, if you found this valuable so far and you happen to be a founder with a business doing over 1 million in ARR, come check out SaaS Rise, our growth mastermind community for SaaS CEOs. It's a private mastermind of over 400 experienced SaaS CEOs and founders who are all navigating challenges like liquidity rounds, fundraising rounds, AI coding, and how to scale up and prepare for a successful exit. We have weekly calls, a private Slack group, and we help each other prepare for these types of liquidity events and make referrals and introductions. If that sounds like you, check out the link at saasrise.com. Who can do these secondary rounds? What are the requirements? So this strategy is not for everyone. There's some specific benchmarks you generally need to hit. First, you typically need to be in the 10 million to 100 million ARR range. Liquidity, founder liquidity can sometimes happen below 10 million if you're profitable, but it's much less common. The most important metric investors will look at is to ensure your company is at least a rule of 40 company. If your annual growth rate's 10% and your profitability is 5%, you're a rule of 15 company. But if your annual growth rate's 30% and your profitability is 25%, well, then you're a rule of 55 company. And you will probably qualify for secondary liquidity if you're at least 10 million in ARR. Here is the deal. This liquidity round doesn't usually happen in Series A's. It never happens in seed rounds, but it can happen in a Series B, C, D, or later funding round, or when you reach that minimum requirement of 10 million in ARR or higher. And if you're bootstrapped, it can happen once you're consistently profitable. This isn't something that you do early, but it can take 3-5 years minimum of building the company to a certain scale. So that's why you really want to invest in a great product, a great team, and great distribution so you can get that company to that critical 10 million mark to make these types of transactions possible. The amount of liquidity you can take out depends on your scale. A 10 million ARR company might be able to sell, say, $5 million in a secondary round, but a $100 million ARR company could potentially take out $200 million in secondary liquidity. We've seen this across the SaaS world. Zapier did a secondary round of $100 million. Calendly did a $350 million round that was majority secondary sale. And ConvertKit did a $6.4 million founder liquidity round. So the market is there for strong companies. But how do you structure the deal? So let's say you meet the criteria. How do you actually make this happen? Well, step one is to get your house in order. You need clean financials, ideally audited with quality of earnings from a Big Four firm, and you need a clear picture of your forecasted metrics. Know your Rule of 40 score, your revenue growth rate, your net margin, your gross retention, your net retention, and hire the right investment banker. Now, who you hire as your investment bank will be the most critical decision you'll make in the whole process. A good banker has relationships with the right PE and growth equity firms, and they create a competitive process to get you the best terms. Don't try to do this yourself to save a few bucks. The 3 to 5% that you pay as the commission and the fee for the investment bank representation will save you a lot of money in the long run, and you'll be able to get a much higher valuation than a 3 to 5% bump. They'll probably help you get a 20 to 40% bump in valuation and save you a lot of time. The banker runs a defined process. They build out a financial model, deck, marketing materials, and data room for your company. And then they go to their network of investors, set you up with meetings, and help manage the indications of interest and the letters of intent. Now, with these letters of intent, the highest valuation is not always the best offer. The terms of the deal often matter just as much. You have to pay close attention to things like liquidation preferences, which determines who gets paid first in an exit. And you also want to look at cumulative dividends, negative covenants that can restrict how you run your business, and anti-dilution provisions. Your banker and your lawyer are your guides here. The last step, you close the round, the diligence is done, the money gets wired, it comes in, the primary portion goes to the company, and the secondary portion goes to you and any other selling shareholders. And basically, that's the secondary sale liquidity playbook. This is how you can turn some of your paper theoretical wealth into real life-changing hard cash without selling your company or even giving up control. This is such a powerful tool for founders who have really genuinely built valuable companies. Now, the thing is, obviously, I can't give away everything for free, so I do want to mention again, if you're a SaaS founder with over 1 million in ARR and you're thinking about your next steps, whether that's scaling, raising capital, preparing for an eventual exit or liquidity event, click the link in the description to learn more and apply. And if you want to learn more about how to scale your SaaS business to the point where a liquidity event becomes possible, click here to watch the next video, which is on the exact B2B SaaS growth system I'm currently teaching inside SaaS Rise, which is hands down the best marketing strategy for any B2B SaaS company. I'll see you over there.